the main macroeconomic news of the coming week is due to come from Europe, in the form of Germany's IFO Business Climate Survey on Tuesday the 25th of May, and Belgium's Courbet Synthetique on Wednesday the 26th. These surveys are important for three reasons. First, Germany is still the EU's economic powerhouse and much of its success is driven by exports. So rising German business confidence would suggest the world's getting back on track. The last IFO reading in April was 96.8, up from 96.6 the month before and just 74.3 a year ago. Second, Belgium's Courbet has a bit of a track record of being a decent guide to the Euro Stoxx benchmark European Equity Index. Quite why Belgian industrialists should be such a helpful proxy isn't clear, and we must remember the past is not a guarantee for the future, but the Courbet has been on the rise of late. The last reading was 4.4 for April, the highest since March 2011. And third, Europe's central bank's next policy meeting set for the 10th of June, and they will be paying attention to indicators like this. As central bankers, economists and investors debate whether inflation's coming or not, it'll be interesting to see if President Christine Lagarde gives any hint on a tapering of quantitative easing or interest rate increases. Remember that the ECB's headline refinancing interest rate has been anchored at zero since March 2016, while its Pandemic Emergency Purchase Programme, or PEP, has a current limit of €1.85 trillion out to March 2022. Now, this latest version of QE has been expanded in scope twice already from its initial level of €750 billion. And that means the ECB's balance sheet now carries assets with a value of €7.6 trillion, up 44% year on year. Now, if they start to think the economy is recovering strongly and inflation is coming, they might start to try and pull back on that. But the stock markets and the economy have bathed in the warmth of this cheap liquidity from the ECB, and there must be a chance they'll feel a bit of a chill if the plug is pulled at any stage. On the home front, we've a very busy slate of corporate news, since a raft of large, mid and small cap names are due to publish results, trading updates or host an annual general meeting, albeit in a virtual format. Names which may be worthy of note or further research include the following: Kainos on Monday the 24th of May, Aveva, Speedy Hire, Shaftesbury, Aston Martin Lagonda on the 25th, Intertek, Severn Trent, British Land, Babcock and Marks & Spencer on the 26th, United Utilities, Johnson Matthey and Ted Baker on the 27th, and then Transport Group, First Group on Friday the 28th. But the group stock which may just cause the biggest fuss in the week ahead is SSE. The FTSE 100 members due to release its full year results for the year to March on Wednesday the 26th of May. Now, shares in the utility are up by a quarter over the past year, which is better than the FTSE 100's gain of 18% over the same period. Not necessarily something you'd expect when in general markets have been looking for recovery and turnaround plays rather than perceived plodders like utilities. But it seems that three factors have helped to fire the shares higher. First, the company's decision to withdraw from the rough and tumble of the retail energy market and its newfound focus on power generation and transmission. Second, SSE's ongoing drive to position itself as a leading provider of renewable energy, with a third of its 20 gigawatt hours of output in the first 9 months of its financial year coming from hydro and wind, and a confirmation of the dividend policy to increase its annual distribution by the rate of retail price index or RPI inflation out to 2023, with last year's 80 pence a share annual dividend as the base. Analysts are looking for around 81 pence a share this time, and that puts SSE in the top 20 yielders in the FTSE 100 index with a yield of nearly 5.5% as I sit here. Now, analysts and investors will also be looking for an update on all three of those, especially after November's sale of 2 energy-to-waste projects raised £995 million in cash. That put SSE on track to raise £2 billion from the sale of non-core assets by autumn this year, following the sale of a 25% stake in Walney offshore wind farm and a one-third holding in a meter asset business called Mapleco. Now, SSE will no doubt also provide an update on its proposed £7.5 billion investment programme, which is designed to help the firm treble its energy output from renewables by 2030. It's already got 2 gigawatts of wind and hydropower operational and 2 gigawatts more in the pipeline. An update on the Dogger Bank offshore wind farm, the world's largest, is quite possible, and SSE is positioning itself again as a leading renewables player. Besides the dividend, SSE set out 3 other financial guidelines alongside its November interim results and then the December and February trading updates. A full year impact upon profits from the coronavirus of between £150 and £250 million was the first. A reduction in net debt to £9.5 billion was the second. And then finally, adjusted earnings per share of 85 to 90 pence a share given normal weather patterns. That excludes gains on disposals and represented an upgrade on the initial estimate of 75p to 80p a share. I hope that you and your families are on good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.